Guys, we're looking at Shea Inc. This is problem 220. You'll notice that Shea Inc., we have an income statement first, guys. That's always the statement that we usually prepare first as accountants. And it's, notice, for the year ended December 31, 2019. And it then has the first line item there is net sales. Now, what I want you to understand is that net sales is sales that are less sales and returns and allowances and less any kind of sales discounts that you may have given. And they just kind of come up with a net sales in order to kind of condense these problems a little bit. So they're just listing it as net sales. So this is sales over a period of time, over that period year ending December 31. And then cost of goods sold, what is that exactly? Like, well, that's a separate, remember, line item, right, for a certain type of expense that we call cost. And if we sell, a blouse for $25 and we paid, $12 for it, we're making $13 as gross profit on that particular item. So this is the amount over the cost that you have paid for the item that you're going to resell. And then, of course, gross profit is the amount that'll go toward your general and selling and administrative expenses and your earnings as well. So it's anything over the cost of the actual goods that you're selling. Okay. So we come up with a gross profit amount, and we actually line item that on an income statement. If you're a merchandising company, for sure, we have a cost of goods sold if we're selling any kind of product. And then, of course, you'll see selling general administrative expenses are underneath gross profit, and then there's earnings. Now, understand these earnings is not net income. These earnings from operations are what it is, the earnings that you receive that have just been a result of the operation of your business. And they usually consider interest expense, like on loans, to be not really a part of your earnings of operations. That's just servicing your debt and a cost associated with your debt, but it's not, they don't want to leave that into administrative expenses and sort of not categorize it properly, so they separate that. And it's just become, it's one of those things, guys, it's become generally accepted. It's just a way they list it on the income statement. So if you got a question on a test about where interest expense is it above or below earnings from operations? Well, it goes below earnings from operations. And then they put an amount, a line item called earnings before taxes, because they really want to highlight the tax amount that they spent. And then we have income tax expense, also underneath earnings from operations. And then, of course, we take away interest expense, we take away income tax expense, and we get net income. So that's our net income amount that will ultimately be closed out, and it'll be put into equity. Okay. So let's see where that happens on the financial statement. And we'll go to the second one here. This is Shea Inc. This is the statement of changes in owner's equity, or I call it owner's equity, stockholders' equity, because we're a corporation here. But if you'll notice, this too is for a period of time. So it's for the year then ended December 31. And we have common stock of 70,000, and then we have this retained earnings. Now we've already had a little bit of problems that we worked associated with the beginning balance and then adding net income. But you notice the net income amount comes from the income statement. And then they take out dividends, and then you have this ending balance of retained earnings that you add to paid in capital to get a total stockholders' equity. So just kind of talking you through these problems. Take note again that there's two sources of equity. There's paid-in capital and retained earnings. There are a lot of corporate statement of changes in stockholders' equity that do not really break those out in distinct bold letters like that, but they're distinctively two different sources of capital. Beware. And then I'm going to just kind of scroll down to the balance sheet for Shea. And what I have hoped now is that you have taken the numbers that are in the book, which is just a listing of accounts with some amounts in them. And they're asking you to put these amounts into the different financial statements. And so you'll know where they go. And this is a key part of understanding and knowing a chapter 2. So let me talk about the balance sheet a little bit. You notice that the date is this December 31, 2019. So all of your balance sheet accounts are considered permanent accounts, and those accounts are as of this date. You have this amount in those particular accounts. So the other two statements that we just talked about for a period of time, the balance sheet is for a point in time, and you're going to see a question on that on the test. Without doubt, there's a good many of you who will randomly get that question on the exam. So just be aware of it. It's understanding the differences between temporary accounts and permanent accounts. The temporary accounts, of course, are revenues and expenses that are on the income statement, and then the permanent accounts from the balance sheet. And remember that the statement of stockholders' equity is just kind of a recap of the equity section of the balance sheet, which is sort of abbreviated. You'll notice at the bottom of the balance sheet here with common stock, retained earnings, and it's just kind of pulled, those amounts are pulled from the statement of changes in stockholders' equity. Note too that that assets here are split between two different types. One is current assets, and then there are non-current assets. And in our country and also globally, they refer to a non-current, asset as being one that is property, plant, and equipment. And they'll very often label it, as PP&E. Property, plant, and equipment is considered a non-current asset. Because remember, current assets are those assets that will probably be utilized up in the next 12 months, whereas non-current assets are something that will be extended and used for much longer than that. Okay, so we have accumulated depreciation, matched up with it. And then we take a look at the liabilities section here, and you'll see that there's accounts payable and accrued liabilities. And I don't get too confused or hung up on the word accrued. What that simply means is that these are liabilities that we have incurred, is all that means. And a lot of companies will separate like some of their liabilities as things that kind of reoccur all the time, and they call them accrued. So don't get too confused by that. But distinctively, notes payable would be considered long-term debt more than, because it actually says so. It says it's long-term. And keep in mind that we call non-current liabilities, then we usually call them long-term debt. And in this case, then, we have two different kinds of equity source. We then have a total stockholders' equity amount, and then that is added to the total liabilities to get the same amount of assets, you see? So those are how a balance sheet really balances, doesn't it? So you have assets equals liabilities plus equity. Well, where'd you hear that? The accounting equation. So the balance sheet is the accounting equation. Okay? Now, I will tell you that they ask us about calculating the average tax rate. You can simply do that by taking the income tax expense and dividing it by the earnings before taxes. You notice is the key here for that calculation. And the tax rate is 35%. Well, this brand new edition that we just got must not kept up with Trump's new law. which we changed. Our corporate tax rate is now more like 20% instead of 35%, which makes us incredibly more competitive on a world stage now. Because at 35%, we were like the second largest um, uh, amount of income tax on corporations in the world. So now we are much more competitive as far as corporations doing business outside the United States with corporations that are based in other countries. So we're very, much more competitive with a 20% rate. Um, the next one is making the assumption they're kind of asking you what the interest rate is that's charged on long-term debt. And so all you simply do is just take the interest expense and you divide it by the outstanding notes payable. This is making the assumption, of course, that the notes payable was outstanding for that amount, that same amount all year long, because it's an assumption you would have to make in order to calculate the interest rate for um, long-term debt. And some of these problems you just have to sort of wing it because they have to just work with the numbers that they give you. And then we have common stock. Obviously, was sold uh, uh, per share. Is $5. So we have common stock, and of course, so often, guys, that when they simplify these problems a little bit, usually there's always a common stock and there's an additional paid-in capital because stock is going to usually sell for a lot more than its par value. But it's in this case, to make it simple, it's $5 because we have 14,000 shares and that amount is given to you. And then we have dividends declared divided by net income, which gives you a percentage, right, of what kind of dividends we paid out. And a lot of companies do this. I mean, they make a policy of paying out 25% of their retained earnings and or the net income that they made, excuse me, for that period. They go ahead and pay it out. And when they pay 25% on a consistent basis, this is a well sought out company. So companies that pay cash dividends on a regular basis are very sought out. That stock is very sought out by investors, and it's steady policy that provides for cash dividends being paid out at that kind of a rate would be real beneficial. So anyway, this is, guys, a finishing up just kind of a discussion about the different line items associated with an income statement, a statement in stockholders' equity, and a balance sheet, and just making some points about that generally as you begin to take those numbers and put them in the appropriate financial statements. What it is that are these things? And I just wanted to kind of recap those statements and show you that there's a standardization to accounting. This is what a income statement looks like. Interest expense and income tax expense is always below earnings from operations. And if it's not, then something's wrong, right? So we very much look at this closely when we analyze financial statements and do a comparative of financial statements with not only other companies, but also with our own company from last year, for example. We'll do common size financial statement analysis where we're looking at ourselves for the last 3 or 4 years and taking a look at what the differences are in our results, right? So that's what financial statements are for too. But anyway, this kind of sums up chapter 2. We'll be skipping chapter 3 and we'll be going to chapter 4 next. And so I'll be talking at you again.